Something just happened in the silver options market that most traders are not talking about yet. While everyone was staring at spot price, the open interest data quietly told a completely different story. You're probably thinking this is just another hype headline about a chart on Twitter. Stay with me, because this is not that. There are three things happening at once right now, and each one changes how the next one should be read. First, a wave of physical delivery notices just hit COMEX. Second, one of the largest short positions in silver history is sitting on the exchange right now. And third, the biggest banks on Wall Street cannot agree on where this metal is headed, and the gap between their targets has never been wider. Before we get into any of it, one thing needs to be said plainly. Everything in this video comes from exchange data, delivery notices, and published institutional research. Not from a chart somebody screenshotted and posted without a source. That distinction matters more in this market than almost any other, because silver has become one of the most rumor-driven assets in finance. A few weeks ago, a chart went viral showing what looked like massive silver call buying at strike prices of $900 and even $1,000. It got shared everywhere. The problem is, those strikes do not exist. COMEX silver options for the relevant contract month top out in the $300 to $400 range, and anyone who pulled the actual exchange specifications could see that in about 10 seconds. That is the environment we are working in right now, so when we talk about big money moves, we are going to build this from data you can verify yourself. Let's build this from the ground up. Start with delivery notices, because this is the least glamorous part of the market, and also the most honest. When a trader takes delivery instead of rolling a futures contract forward, they are saying something with their capital, not with their mouth. This month, COMEX silver delivery intentions climbed into the tens of millions of troy ounces, representing well over 1,000 metric tons moving through the delivery process. Names attached to those delivery notices include major desks like JP Morgan Securities, Macquarie Futures, BNP Paribas, RBC Capital Markets, and Deutsche Bank. Delivery notices do not guarantee metal leaves the vault the next day, but they represent an actual intention to hold physical silver, not a paper trade that gets closed out before expiration. That is layer one of the picture, and on its own it is interesting but not conclusive. Now add layer two. At the same time, institutions are pulling metal into delivery. A well-known Chinese trader based in Gibraltar has built one of the largest net short positions in silver on record, reportedly around 450 tons, close to 30,000 contracts. This is a trader who reportedly made billions on a long gold position over the last several years, so this is not someone making an uninformed bet. His short position has produced a paper profit in the hundreds of millions of dollars during silver's recent pullback from its January highs. Here is why that matters for how you read everything else in this video. You now have large institutional money quietly taking physical delivery at the same time a sophisticated trader is running one of the biggest short bets in the market's history. Those two facts do not cancel each other out, and they are not supposed to. They represent two completely different bets on two completely different time horizons. And understanding that gap is the whole point of this video. Now, for the third piece, because this is where it gets genuinely strange. Reuters polled a group of analysts, and their average silver price forecast for this year came in around $79, up sharply from around $50 in a poll taken less than a year earlier. Bank of America's metals strategist has one of the most aggressive targets on the street, citing historical compression in the gold to silver ratio, with a range that stretches well past $100, and, in his most extreme scenario, into the 200s. Citigroup has its own target sitting in a similar elevated range, and at least one independent macro strategist has published a call above $150. When you have Reuters, Bank of America, and Citigroup publishing numbers that far apart on the same asset in the same year, that is not analyst noise. That is a market that genuinely does not know what silver is worth right now, and that uncertainty is exactly the kind of environment where large positioning like the delivery surge and the short bet becomes more important, not less. Underneath all three of these signals sits a structural story that has not changed even as prices whipsawed. The Silver Institute has now flagged a sixth consecutive annual supply deficit, with the shortfall estimated near 67 million ounces. Registered COMEX inventory relative to open contracts remains historically tight, and premiums on the Shanghai Exchange have stayed elevated, both signs that physical metal is harder to source than paper contracts would suggest. On top of the deficit, industrial demand keeps climbing from solar manufacturing, electric vehicles, and data center build-out, none of which cares what the short-term chart is doing. Now here is a question worth sitting with for a second. When you see delivery data, positioning data, and institutional forecasts pulling in different directions at the same time, do you wait for someone to tell you what it means? Or do you learn to read the primary data yourself so nobody can hand you a fake chart and have you believe it? That is not a rhetorical throwaway line, because the fake $900 strike chart fooled a lot of people who consider themselves serious market participants. So let's talk about what each side of this actually implies going forward. On the bullish path, the delivery surge continues. More institutions choose to stand for physical rather than roll contracts, and the tightness in registered COMEX inventory becomes impossible to ignore, which is the exact setup that historically forces short covering and can push price toward the upper end of the range that Bank of America and Citigroup have published. In that scenario, the large short position becomes the fuel for the next leg up rather than a warning sign, because forced buybacks on a position that size do not happen quietly. On the bearish path, the short seller's thesis plays out instead. Macro pressure from rate expectations or a stronger dollar pushes speculative long positioning out of the market. Delivery notices taper off as the July contract rolls into the next cycle, and price drifts back toward the lower end of the Reuters average, testing support levels that formed during the recent slide off the January highs. In that scenario, the delivery data we just walked through gets reinterpreted after the fact as normal seasonal positioning rather than a signal of anything larger. Both paths are sitting on the table right now, and the exchange data over the next several delivery cycles is what tips it one way or the other. I'm not going to pretend I know which path wins, because anyone telling you they know for certain is doing exactly what that fake options chart did, just with more confident phrasing instead of a screenshot. What I will tell you is which data points to watch, because the next delivery report and the next update to that short position will tell you more than any forecast published today. We are going to be tracking both of those closely, because whichever way this resolves, it is going to happen in the data before it happens in the headlines.